Picture this. You give away what feels like a small warehouse of stuff. You're sure it's valuable. You report roughly $189,000. Then that number becomes roughly $194,000 on the tax return. Then about 3 years later, after an audit fight, that swing works out to an increase of about $6,000. And in the end, the IRS allows about $6,000, while the court says about $189,000 of it isn't deductible at all. That's not a charity win, that's a substantiation wipeout. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like this kind of story-driven breakdown, please like this video and subscribe to this channel. This channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law works. In this video, we cover the tax court decision in the case of Luke Gibson and Brianna Gibson versus Commissioner of Internal Revenue, decided on January 6, 2026. The court tells us right away what kind of decision this is. Tax court summary opinion under the small case procedures, and this opinion shall not be treated as precedent, meaning you cannot cite it as binding authority in other cases. Still, as a real-world cautionary tale, it's very useful. The story takes place around the taxpayer's 2019 return. They lived in California when they filed the petition, and they filed their joint Form 1040 for 2019 on time. The return is where the stakes first appear. On Schedule A, they claim non-cash charitable contributions in the neighborhood of $194,000. The return supporting paperwork matters here because this case is basically a courtroom close-up of the IRS obsession, show me your support. The taxpayer attached Form 8283, non-cash charitable contribution, and it listed 3 buckets of donated property. 2 buckets were comparatively small, together around $6,000 of claimed value. The third bucket was the monster item that drove the whole dispute: high-end cycling apparel. The cycling gear donation is where the numbers start doing weird gymnastics. On the Form 8283, the taxpayer described the cycling property as acquired by gift. They also listed a donor's cost or adjusted basis in the ballpark of $251,000, while claiming a fair market value of roughly $189,000. And then they checked the box that said the valuation method was appraisal. But here's the first quiet problem. The court notes they didn't file any appraisal with the tax return. That's the kind of omission that feels harmless if you've never been audited, until you learn the hard way that non-cash gifts over certain thresholds don't just want some paperwork, they want specific paperwork. Then the audit arrives. The IRS examined the 2019 return. During the examination in May 2022, the taxpayer submitted an amended return, Form 1040X, with an amended Form 8283. This is the moment where the people often try to patch missing documentation, and sometimes that works. Here it didn't. The IRS did not accept the amended return. What did they attach to the amended package? 2 key things. First, a receipt from the charity Highway 80 Rescue Mission Ministry dated March 26, 2019, with an itemized list of what was donated. Second, an appraisal setup, Part 3 of Form 8283, Declaration of Appraiser, signed by an individual and dated July 1st, 2019, plus a report dated March 26, 2019, that said the valuation was determined as of the donation date. The report put the fair market value at basically $189,000. So far that sounds like we donated stuff, here's the receipt, here's an appraisal. But the tax court isn't grading on vibes, it's grading on statutory checklists. After the examination, the IRS issued a notice of delinquency dated July 18, 2023. the IRS allowed only small chunks, about $6,000 total, and disallowed the cycling apparel deduction of roughly $189,000. And the notice's explanation reads like a greatest hits album of why non-cash deductions get chopped. The deduction is measured by fair market value at the time of the gift. Some property is limited to cost. You must substantiate each contribution, and if you don't, the IRS adjusts to what it can verify or what it thinks is reasonable. By the time the case reaches trial, after concessions, the court says only one issue remains: whether the taxpayers can deduct approximately $189,000 for those non-cash charitable contributions for 2019. Everything else either is stipulated or computational. The opinion even lists what was settled: a cash contribution adjustment of about $2,000 instead of approximately $7,000 in the notice, a general business credit around $74,000, and additional unreported income around $87,000 that should have been reported on Schedule E, but the entire narrative spotlight stays on that cycling gear. There is also a courtroom mechanic movement that matters because it shapes what evidence actually gets in. The parties filed a stipulation of facts with several exhibits, but the IRS objected to portions of hearsay and rule compliance grounds, and the court sustained several of those objections. What does that mean? The court didn't just accept everything the taxpayers wanted to slide into the record. If it didn't meet the rules, it didn't come in. Now we reach the legal heart of the story, and the judge lays it out in plain tax court language. The IRS's determination in a notice of deficiency is presumed correct, and the taxpayer bears the burden to prove it wrong. And the opinion repeats the theme every taxpayer learns sooner or later: deductions are a matter of legislative grace, and you have to prove you qualify. The court also notes the taxpayers didn't show that the burden should shift under Section 7491A, so the burden stayed with them. Then we zoom in on the substantiation rules for non-cash charitable contributions. At the basic level, non-cash gifts need a receipt from the donee organization showing the organization name, the date and location, and reasonably detailed description of the property. And for gifts of $250 or more, you generally need a written acknowledgement with certain required information. The taxpayers actually did okay on that part. The court specifically says that with itemized receipt from Highway 80 Rescue Mission Ministry, they met the requirements for contributions of $250 or more, and the parties didn't dispute that the organization qualified under Section 170. So why did they still lose? Because once you're dealing with a deduction around $189,000, the rules climb into a different weight class. The court points to additional substantiation rules that kick in for non-cash contributions over $500 and over $5,000, and the taxpayers, in the court's view, failed those higher level requirements in two separate ways. First failure, the over $500 record keeping requirements, especially bases in acquisition details. The court says the taxpayers didn't explain how the lead taxpayer acquired the property, didn't provide the approximate date of acquisition, and didn't provide the cost or other basis as required. And the opinion adds a vivid detail. This wasn't a handful of items. The court describes it as over 4,000 items of property. That scale makes the missing substantiation even more glaring because it raises the obvious follow-up. Where did all this come from? And what was the basis story? The testimony didn't save them. The court says the taxpayer's testimony was vague about who gave the property as a gift. It was unclear whether it was inherited or gifted during the family member's life, and the family member wasn't named. The taxpayer also claimed it was impossible to get the property's value in the hands of the family member. Yet, when asked to explain why it was impossible, he said it because it was a gift. In other words, the court heard the explanation and it didn't connect to the legal requirement. The law doesn't say if it was a gift and it's awkward or to reconstruct, you get a pass. The court basically says the opposite. If you want a non-cash deduction over $500, the law requires detailed substantiation of basis and acquisition timing. And then comes one of the more painful lines in the opinion, because it captures a mismatch between what the taxpayer thought the rule was and what the rule actually is. The court says the taxpayer gave confusing testimony and at one point suggested he thought the deduction value was the fair market value discounted by 25% to 50%. The court notes he provided no support for that statement. Let me explain that in a more simple language. The taxpayer seemed to believe there was some kind of informal discount formula, like I'll just haircut the value and that makes it acceptable. But tax deductions don't run on folk wisdom. They run on what the statute and regulation demand and on what you can prove. Second failure, the over 5,000 appraisal requirements, specifically proving the appraiser was qualified. The taxpayers did eventually produce an appraisal report in the amended submission, and it pegged the fair market value at roughly $189,000 as of March 26, 2019. But the court points out two damning gaps. The appraisal didn't indicate the taxpayer's basis when he acquired the property, and more importantly, for the $5,000 plus rule, the record doesn't confirm the appraiser was a qualified appraiser. The phrase qualified appraiser is doing a ton of work. In plain terms, it means you don't just need an appraisal. You need an appraisal that meets the rules, and you need the person who prepared it to meet the definition. Here's the court says the taxpayer didn't prove it. So the court lands the plane. It agrees with the IRS that the taxpayers are not entitled to deduct approximately $189,000 for those non-cash charitable contributions. And notice what's almost tragic about the outcome. The court explicitly acknowledged they had the itemized receipt and there was no dispute the organization was qualifying. This wasn't a fake charity story. This wasn't a no receipt at all story. It was you were trying to claim a very large non-cash deduction, and the higher tier substantiation rules are unforgiving story. The opinion wraps up in classic tax court fashion. It considered all arguments and found anything not discussed to be moot, irrelevant, or without merit. And the decision would be entered under Rule 155, meaning the final numbers get computed under the court's direction. So what's the lesson? Delivered with the appropriate amount of tax seasoning? If you're going to donate what the court describes as over 4,000 items and you want a deduction in the vicinity of $189,000, you don't get to show up with vague origin stories, missing bases, and an appraisal that the records can't even anchor to a qualified appraiser. The IRS and the court don't grade generously. They grade proof. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. If you like this video and found this information useful, please give us thumbs up and subscribe to this channel. And I'll see you in the next tax court case review.